I would also like to start by making a disclaimer, because Carsten and I hadn't looked very much into this area before we decided that we were sort of in big trouble, because generally the Danish perspective on these areas has been to do as little as possible. So we don't really find a lot of regulation that supplements what is in the mandatory EU regulation. Denmark being a small country, we don't really find any practice, and we don't really find any discussions in literature or in the academic world in general. So our approach here today is to try to pin out some of the areas where we find that we do have something to contribute with from a Danish perspective. So it's a little bit of cherry picking, and I hope that you will excuse that for today, and then when we do the report, we will try to elaborate. And I think one of the good things about being here is that we get a lot of inspiration for filling out the holes. So with those few words, we will get started. And we will start by looking at some general perspectives on voting rights used by investment companies. In Denmark, even though we didn't see the same post-crisis discussion on the role of shareholders and active ownership as we saw in many other European countries, the Committee on Corporate Governance in Denmark decided that we should have a stewardship code. So in 2016, the Danish Stewardship Code was adopted. It was greatly inspired by the UK Stewardship Code from 2010, but it was also framed with an eye to the ongoing work on the SRD2. So when the SRD2 came into force in June 2019, it didn't really mean a lot of changes for the Danish institutional investors and asset managers, because they had already been introduced to the system by the Danish Stewardship Code. But still, the Danish regulators said that because we wanted the institutional investors and asset managers to have time to adjust to this new framework, the introduction of the provisions on disclosure for institutional investors and asset managers was postponed to financial reports for the years starting January 1st, 2020. So basically, it's not until this year and the reports that are being introduced right now, we start to see exactly how institutional investors and asset managers implement the different provisions that are found in the SRD2. The SRD2 in Denmark is transposed into a number of different acts, including the Companies Act, the Financial Business Act, the Investment Fund Management Act, and the Alternative Investment Fund Management Act. So because it was introduced into these existing provisions, the term institutional investors wasn't really translated in any way. We just carried on with the terms that we found in these different provisions, rather than having one collective term covering all institutional investors. But in one place, the Danish transposition differs a little bit from other countries, I think, in the way that in Denmark we have two large institutional investors that are called the Danish Labour Market Supplementary Pension and the LD Pension Fund, which are both funds that are set up by the state going way back, but still have a function and are quite large on the institutional fund market in Denmark. So the implementation was expanded also to include these two institutional investors, and in that way, the general provision was that now we had included all the important institutional investors in Denmark. Another thing that should be mentioned here is that the provisions cover all the active or the equity engagement by institutional investors. So it's not limited to investment in Danish companies. It's investment in any company that are listed on a capital market, whether it's in Denmark, in Europe, or in the world. But in general, besides these two particular aspects, in general, the implementation into the Danish acts are very true to the wording of the SRD2 directive. So we don't really find a lot of a Danish deviation here. It should also be mentioned that when the SRD2 was being transposed into Danish law, the Danish Corporate Governance Committee announced that the Stewardship Code would be abandoned. And this is interesting because they didn't set a due date. And when you look at their website, you can still find the Stewardship Code, but basically it's been taken over by the SRD2 implementation. So we still have this alternative framework that's a little bit floating right now because we're not really sure what the status is and whether it will be abandoned completely at some point of time. And I think in this perspective it's interesting because if we had maintained the Stewardship Code as an alternative to the provisions found in the SRD2, we could have had a framework where we could develop different aspects in relation to engagement and in relation to stewardship. For instance, including the whole sustainable discussion, which is not really a part of the SRD2. But now we only have the SRD2. And this also means that some of the developments we see around the world, for instance in the UK, to the understanding of stewardship, we don't see that in Denmark. And just like Eric mentioned in relation to Sweden, when it comes to the practices of institutional investors and shareholders in general, the shareholders have a lot of power. And in this respect, the Danish and the Swedish rules are more or less the same. We come from the same legal tradition, and corporate governance codes, and in particular the Companies Act, have developed in parallel paths. So shareholders can put anything on the agenda on the annual meetings that has to do with the company. So if we look at sustainability, they can put any issue to the agenda, whether it's for a discussion or it's for a vote that has to do with sustainability or any other issue that has to do with the operating of the company. Also, any resolution that is decided by the general meeting is binding for the board of directors. So the board of directors has to do what the shareholders tell them to do. And basically, if the shareholders are dissatisfied with what the board do, they can dismiss them without cause. So this is sort of the ultimate threat. And even though, of course, we don't see that in listed companies, it's definitely a threat in smaller companies that the shareholders will just get rid of the board and find a board that wants to implement the different directions that the shareholders give. But the shareholders do actually have a lot of power in the general meeting. So a couple of years ago, Carsten and I looked into the practices of the general meeting in Danish companies to see if the shareholders actually put the power they have on paper into use. And we looked at the 2018-2019 annual general meeting season, and we looked at all the reports from the general meetings to see, do we find any issues where shareholders actually sort of take a leading stance. And when it comes to ESG and sustainable discussions and issues, we didn't really find anything at all. There were actually no decisions that were put forward either by the board of directors nor by the shareholders in relation to these areas. But in relation to corporate social responsibility, which is a little bit related, we found that out of 47 shareholder proposals, there were 7 proposals that related to CSR issues. None of these were put forward by the institutional investors. And this was after we had the Stewardship Code, so we could have expected that the institutional investors would have been more active. But we didn't see any shareholder proposals being put forward at all by the institutional investors, only private investors, retail investors. We haven't had the opportunity to make a new survey to see if this is changing. What we know is changing, that the whole sustainability agenda is becoming much more emergent for companies as well as for shareholders. So we could expect in the years to come that we will see a change also in the practices of the general meeting.
And then the next issue we decided to include was the possible obstacle to this engagement. And we did look at the mandatory bid rules, and of course discovered that we have it, and we also have a discussion about the concept of acting in concert. And it is also, as I gather from other presentations, it is an issue which is discussed, and there is a fear that it might affect shareholder collaboration and engagement. But there are a number of factors which actually may make it less likely that it is a problem. First of all, you need to acquire a third of all the voting rights. And even if you do that, so if you have a coalition which is large enough to cover that many votes, of course there might still be a controlling shareholder, which is actually often the fact in many Danish listed companies. And if there is such controlling shareholders, it won't trigger any bid. But if you look at the rules, the concept of acting in concert, we only have few cases, and these mainly concern not collaboration between investors, but collaboration between related parties. So family members or a controlling shareholder and his company, etc. And that, of course, will easily amount to acting in concert. But there's agreement, and we also have some case law indicating that it does extend to other type of relationship and could, in principle, also, of course, affect investors. We have two reservations, though. That one of them is that if it only involves a few issues that they're collaborating about, that makes it less likely. And the other one is that if it's only for a short period. But then again, of course, the issues might be so important as, for instance, changing the composition of the board, that anyways, it will be enough. So still we cannot say that it's unlikely, it's just less likely. But then we also have the requirement that there should be a transfer of shares. And this, of course, is still allowed, and it's not mandatory, and I understand that member states have different rules, but it means that if the institutional investors or the investors going together about these issues and collaborating don't buy immediately before, because that could be circumvention, or after they establish this cooperation, then they should be okay. So they just should make sure at least not to buy, and possibly also not to sell in the period where they are collaborating. There is an interesting story, though, because in 2013 there was a proposal to change the rules, and they were changed substantially. And one of the proposals in the original proposal was that this transfer share condition should be removed. So it would be enough just to establish a collaboration, and it would trigger. And actually it ended up with that specific proposal being taken out because there was a fear that it would restrict collaboration and engagement. So in a way, they have made it easier for the parties to avoid. I also felt the need to I have written something about gun jumping recently, which of course is a problem that you fail to notify a merger, which has now attracted a lot of attention in Denmark because we had some cases, but also of course attracted attention in Europe because we have had cases with substantial fines. So it's very important not to trigger. And this discussion is very similar as acting in concert. It is enough for a group of shareholders who has control, and that is also de facto control, which in a listed company could be as few as 30–40% of the votes. But again, to have control, you should exercise decisive influence. And what does that mean? There hasn't been any discussion in merger law, merger control law, and I should say that the Danish rules are mirroring the EU rules. So I'm talking about now the EU rules. There has been any discussion, to my knowledge, whether collaboration on these issues will trigger or could trigger a merger regime. But in other areas of competition, or the Commission is trying now to upgrade and take into account the ESG agenda, and it could be actually that they will also do so in this area. So that brings me to the next problem, which was credit governance, which has been touched briefly, I think, by some of the presentations so far, and we thought it was very intriguing, and the problem is that it's very difficult to figure out what's happening in the banks, and there isn't any templates we could take and say, well, this is representative of what they normally use in the major banks, because each banks have their own probably templates and they do not disclose it. So you need really to get into contact with the banks. But we can see that the banks are actually claiming that they are sustainable because they are inducing their customers to be more sustainable. For instance, to buy more sustainable cars. And they actually make statistic about how many of their loans to finance cars are more sustainable. But of course, in that case, sustainable cars, I guess you don't need covenants. But for other loans, you would need covenants to ensure that they are in fact sustainable. So we contacted, and as I said here, or we said here on the slide, it's very limited. We contacted a very good friend we had, which is the head of legal in one of the bigger banks, one of the biggest banks in Denmark, and presented him with, just to get an insight. And he did explain to us that they do use covenants for that purpose, but they mainly do it at this point for short-term loans. And in particular for his bank, it would be loans for constructions, so building of houses and premises, and they are aiming to have low energy utils in these constructions. And the way they're doing it is to include covenants, but mainly as soft law commitments. So they include it, and then they pay out the loans, but there is no consequences if they are not complied with. And he even said, and he repeated that a couple of times, that there's no guarantees that you will get a lower rent or interest if you're committing to these. So he admitted that at this point it is in a very early stage, and they haven't, of course, so far tried it with longer loan engagement, which of course would then have to involve, I guess, governance, which also includes specific limitation on the management or how they should behave or how they should report on different issues. He told us they were not there yet, and it was his impression that the general market in Denmark was not that developed. So we would like to hear whether you have any good ideas about how to approach this, because evidently if we should include anything about this in the report, we need to have definitely more empirical data. We got the impression that the banks are probably not ready to share it because they are not that far advanced and they are afraid to be criticized, which of course we can't promise them not to do, and most likely will do if it's not really up to date. So I think most likely we are at a dead end here and will not be able to really present anything in the report. But we thought we would share at least this very limited anecdotal evidence that we had found.
And this moves on to the next issue, which is the inclusion of debt investors in the activist program. And I think this particular question is one of the interesting developments in the UK Stewardship Code, that you should be active not only in relation to your equity investments, but also to other types of investments in debt and also in alternative investments. And maybe because we abolished the Stewardship Code, maybe because we have this very strong focus on the rights of the shareholders and sort of ownership rights of the shareholders as well, this is not really anything that's being discussed in Denmark in relation to the institutional investors. But if you look at from the other side, from the investee companies side, this is something that the dialogue also with other types of investors is something that we found in the Corporate Governance Code, and something that has been in the Corporate Governance Code ever since the first code in 2001. And here it's emphasized that listed companies should engage not only with shareholders, but also with creditors, other types of investors, and in general, any kind of stakeholder that might be relevant for the given company. So there is a focus on the dialogue between companies and different types of stakeholders and different types of investors, but not from the investor side, but from the company side. This is not, besides the soft law approach we have in the corporate governance code, we don't really find any attempts to strengthen this framework. So we don't see any discussion on whether we should go from the soft law approach to a more binding approach where the companies or the institutional investors are forced into these, or not forced, but trying to be pushed into these dialogues. Also, because we know that the dialogues take place, especially with institutional investors, that they are very much emphasizing this in their engagement reports, but we don't know anything about the content of the dialogue because it always takes place in private. And we haven't had any studies in Denmark where we look into these behind-the-scene practices. But the practices there, and especially the institutional investors, view it as being very important. It is something that has been emphasized even longer going back before the Stewardship Code in 2016, and was one of the arguments put forward by the industry that we didn't really have to have such an engagement framework because there was a lot of engagement and dialogue going on already. We just don't see it because it's sort of hidden in the practices that they have.
Yeah. So following that, given that we know we have this dialogue between the controlling shareholders and the institutional investors and the board of directors, it's of course would be natural to look at the barriers there is for this type of dialogue. I should also mention that apart from the fact that we know from these engagement policies and other statesmen that it does happen, it also probably is the explanation that when we did the study of the general meetings, we discovered that there is hardly any real dispute about the proposal proposed by the board, and these are by far the majority of the proposal at the general meetings. They are all adopted with 95% or more consent, and it does really indicate that all these issues have been cleared before the general meeting. So there is a certain, at least, indirect evidence that this is a very important mechanism. And then it has been so for very long that we have this discussion, and it also seems to be accepted that this is the Danish way of doing things, or probably the Nordic way of doing things. And therefore, even though there are legal problems around this, they have been debated I think, in clearly with the clear motive of trying to avoid any clashes with these rules. And to a large extent, it seems that they have managed. At least there's not very much critical debate about this. So, for instance, we have rules, of course, on duty of confidentiality. So the board is not allowed to share trade secrets. And of course, it seems that it would be likely that they do at least share some trade secrets when they have these meetings. But there is an agreement also that the board can make a decision about what information they can share. And if they make a decision about this, then it probably is acceptable, and then we are outside the scope of this prohibition or this duty of confidentiality. So that's one aspect. And also there's a discussion that they always argue that they will give it in, maybe they do reveal some trade secrets, but then they commit the receiver to treat them in confidentiality. And some practitioners or some legal scholars think that this will be enough to cope with this ban on sharing this type of information. I'm not convinced. We also, of course, have equal treatment, and again, it seems that there has been actually surprisingly little discussion about this, and it seems the consensus is that, well, as long as it's justified, you're sharing only if it's in the interest of the company, it will be okay. And this, of course, gives you a lot of room for maneuver, and therefore it's okay. And lastly, we of course also have the insider trading rules, and here the consensus is that if you share insider knowledge, then you should just make it clear to the receiver, the institutional investors or whatever, that this is inside information, and then of course they will also be bound by the limitations of the insider trading rules. So, as I said, very pragmatic interpretation of the law.
And so we are moving on to fund governance, and as you will see, we have even less here. When Article 3H was being transposed into Danish regulation, we hardly found any discussion at all. And when you look into the preparatory works, it only says that the company should disclose whether or the institutional investors should disclose whether it follows an active or a passive investment strategy. That's it. So it doesn't really make us any more knowledgeable on what is an investment strategy or what we expect of an investment strategy. And in this respect, of course, the sustainable finance disclosure regulation might help us develop that area a little bit further. But the Danish Financial Supervisory Authority are very reluctant in this area, waiting to see what's coming from the EU. So if you look at the website, there's hardly any information there besides links to the EU regulation. And when we talk to them, they also say, well, we don't really take a leading role here. We're kind of waiting to see how to, what the expectations are from the EU. But what has been done in relation to Article 3G is that last year the FSA conducted a very limited survey of the implementation of 3G into the practices of 8 banks and 4 pension funds. So it's a very small sample. But what they found here in general was that that the undertakings didn't do very well. Basically, what they found was that the implementation and the policy description was very general. It didn't relate to the specific companies. It didn't relate to the specific sustainability risk that was or could be a problem in the given undertaking. And they also found that the undertakings mix the inside out and the outside in approach. So they were looking at the sustainable risk policy in relation to their own ESG practices. So they were told to separate the two and have a clear focus on the sustainability risk policy and be more specific and precise in relation to how it related to the specific company. And the FSA said at that point of time that the survey didn't result in any supervisory reactions, but that it was something that they would have a very clear focus on in the future, and therefore also saying that if you don't get better at this, then the hammer will fall at some point of time. Finally, in relation to fund management, I want to mention that when it comes to the potential conflict between ESG and prudential portfolio strategies, the FSA hasn't said anything in relation specifically to sustainability, but previously they have been very clear that that companies should have a focus on maximizing returns to the beneficiaries. And if you want to integrate other aspects, and we expect that to include sustainability as well, it has to be held within the investment strategy. So you can't do anything that you haven't clearly promised your investors or agreed with your investors that you will do. So if the investment strategy doesn't include sustainability, then you can't include any sustainability considerations unless you still maximize return to shareholders. So we have an expectation that this is going to be how the FSA look at it, but they haven't really said anything explicit yet. They have also indicated, though, in particular in relation to Article 9 funds, that as they see it, that setting up Article 9 funds could be a violation of fiduciary duties because the investment universe just becomes too narrow. So with such a narrow universe, you can't maximize return to shareholders. But when we look at the practices of the investment funds, they are setting up Article 9 funds. So we are not really sure what's going to happen here yet. So maybe before we have finished the report, we will have more knowledge on that. But that's sort of an interesting perspective. And then finally, a comment on product governance.
We do not find much there, but we did find that there are some attempt at least to limit greenwashing. We have a consumer ombudsman in Denmark who is quite active in enforcing the marketing law, and they also have the authority to issue guidelines, which are then normally also applied by, of course, the ombudsman herself, but also by the courts. They are actually accepted as being the valid interpretation of the law. And the ombudsman did adopt guidelines on environmental and ethical claims in 2014, applying to all goods and activities, so also applying to financial products. Of course, since they apply to such a broad range of different activities and goods, of course they have to be of a very general nature, and the information we got is that the financial institutions are not particularly happy about them. They found them difficult to apply, but nevertheless they do apply. At least that's the case for the time being, because it does not apply if there is specific legislation. And now, of course, we are the taxonomy regulation will enter into force gradually, and eventually when that happens, I will expect that will take over at least the area covered by that regulation. But just to say why they might have been a bit frustrated about it is that they make a distinction between general statement, as for instance that we have a very green product or it's climate friendly or similar to that. And to do that, you need to be among the very best products. So it's not just enough to be part of the more sustainable part of the market. You need to be among the very best. And of course, this might be moving all the time. So therefore, there are only very few companies who can make that claim. And that is something that the industry is not that happy about. And I guess the approach is quite different from the taxonomy regulation. And if you're making that claim, you also have to document it with a life cycle analysis. So they are quite strict on these types. So it's difficult. And then you have more specific statements which are not claiming that they are in general just good, but have features which are good for the climate or ethical aspects, and that's easier to document. So there you have the possibility to go ahead. As for sustainability, that is also addressed specifically. If you call your product sustainable, you should make a life cycles analysis, and you should analyze whether it impedes the possibility of future generation, which I guess is quite difficult to do. And they state themselves that very few will have the opportunity to use that term, because it would be very difficult to do. So that is a very restricted term and will be very difficult to use. If you do not comply with these, it may have sanctions. Of course, you might be fined. By the consumer ombudsman will take action and bring it to court and have a fine imposed. But the consumer ombudsman may also take actions on behalf of consumer who has suffered a loss, and they can have class actions on behalf of a group of consumers, and they take the case to court. And I've done so far in some cases, not many, but at least it's a possibility. So it's they take it serious, I'm sure. So I think that ends our presentation.